Hello and welcome to the Pine Street Capital YouTube channel, where we talk all things trading, investing, and personal finance. My name is Ron and I'm the managing partner of Pine Street Capital. I've been trading for over 6 years and today's topic is trading strategy. Now, we got to this topic because I posted a question in our trading community on Telegram, which, by the way, you can join using the first link in the description, basically asking what the community would like to see a video on. And a lot of the responses I got were around trading strategy, demand and supply zones, order block strategy, things of this nature. So I decided, you know what, why not strip it down to its bare bones and cover trading strategy. So with regards to trading strategy, the very first thing to point out is a lot of people use the word trading strategy and trading system sort of interchangeably, when in fact they are actually two different things. Trading system is actually the what within your trading strategy. So what kind of market environment do you trade? What kind of setups do you look for? What kind of stop loss do you use? What's your risk management process? What's your trade management process? And your trading strategy is the why of the what that you decided, if that makes sense. So essentially, if you've got, if you set a 30 pip stop loss on every single trade that you've placed, then the reason why you place a 30 pip stop loss is the strategy that you got to place that trading system input with. So that's essentially the difference between the two, but for simplicity's sake, I've decided to use the words trading strategy and trading system interchangeably. Why is it important to have a trading strategy? Now, a trading strategy is important because it allows you to have a repeatable process by which you can consistently make profits in the markets. And it's important to have a repeatable system because it plays into the consistency of your approach in the markets. So the moment you've got something that you can repeat over and over and over again in the same way and it's profitable, you can become a consistently profitable trader, right? So that's the reason why a trading strategy is important. Okay, so what does a trading strategy actually consist of? Now, with any trading strategy, you need to identify the type of market environment that you trade. You need to identify the trade setups that you take. You need to identify your risk management methodology, and then you need to determine your entry criteria and exit criteria. Let's start with identifying the market environment. Now, there are broadly three types of market environments that you can trade, which are the trending market, either upward or downward, right? And then you've got the range bound market, and then you've got the erratic sort of special situations market. Think of the market after, just before and after the non-farm payroll has been released. So those are the three market environments, and once you determine which of these market environments you're trading with your particular trading strategy, then that's the first filter of whether or not there's opportunity. Now, the next thing you need to identify is the trade setups that you take. Are you going to take a break of the previous trend, i.e. 2 consecutive higher highs, 2 consecutive higher lows? That is the classic setup for trend trading strategy. Or are you going to take a bounce off support for, say, a range bound strategy? Or are you going to trade continuation patterns like say an ascending triangle, a descending triangle? Are you going to trade flags? Those are the types of trade setups that you've got. And then next, you need to identify your risk management methodology. What's your position size going to be? How are you going to set your stop loss? How are you going to manage sort of scaling in and scaling out of positions, right? So call it risk management, trade management. Then you've got your entry criteria, which is how exactly do you get into positions? Do you leg into your positions? Do you enter one time? Do you enter on a break? Do you enter at the close of the candle? The next thing you need to identify is your exit criteria. Now, how exactly are you going to exit when your trade goes against you? Are you going to exit at a hard stop loss that you set? Do you have a soft stop loss in there that you execute manually? Do you sort of trail your stops? Do you trail your stops in the losing position? In a winning position, do you take half of your profit at a 1-to-1 or 1-to-2 risk reward and then let the rest of it run until it hits your trailing stop? Do you take all of your profits at a 1-to-2? Do you take all of your profits at a 1-to-3? And what determines when you get out of a position that's moving in your favor, that's moving against you, that type of thing. So those are the things that you need to identify within a trading strategy. I'm going to walk you through an example of how this works practically so that you have an idea of what you need to do in order to build up your own trading strategy and the kinds of questions that you need to ask yourself. All right, so here's a simple example of a trading strategy, right? So within this trading strategy, we are going to go through the 5 different aspects of it that we need to set out from the get-go. Now, this is a very simplistic example, and there's a lot more detail that we can add to the trading strategy. But in essence, what this example is supposed to give you is the framework with which you can then apply to your own trading strategy. Okay, so within this trading strategy, we identify the market environment that we trade this trading strategy within. And with this trading strategy, we trade it in trending markets. That's upward trending markets and downward trending markets. So when the market is range bound, or when there's some kind of special news or economic announcement, we're out of the markets. We only trade trending markets. So when the market's trending upwards or when it's trending downwards. The next thing we need to identify is what setups we trade. And we are going to be trading bullish flag patterns and bearish flag patterns. Those are the only 2 setups we're looking for when we look at the charts, and we're after identifying the trend. If we identify an upward trend, we are only taking a trade when we see a bullish flag pattern. And when we identify a downward trend, we're only trading a bearish flag pattern, right? And if you don't know what that looks like, you'll see it once we get through all of this. And the next thing we need to do is we need to identify our risk management parameters. So in this example, we are risking 1% of the account per trade. And the position size, i.e. the lot size, is determined by the distance of our stop loss, right? And we have a fixed stop loss that is determined before we enter the market, and we come to the stop loss from the market structure. And you'll see that in the example. It'll all be a lot clearer once you've actually got the visual of what it looks like. So the next thing is entry criteria. We execute the full position size with the market order at a break of the trend line. Then the exit criteria is we have no trade management at all. So the trade can only be exited once it hits either the take profit or the stop loss. And the take profit is 2 times the distance of the stop loss. Very simple. So practically, this is what it looks like. This is clearly an upward trending market, right? So the market's trending up, then it starts to consolidate a little bit, up, down, right? So what we are looking for is a break through the trend line in this flag, and that's identified by this circle over here. So at a break of this, we go long. According to our entry criteria, we execute the full position with a market order, right? And our stop loss, we've got a fixed stop loss set at the previous low, as we stated before. So this is the previous low right here. So we enter there, stop loss over there, and the take profit is simply 2 times the distance of the stop loss, right? And that's this area over here. So as you can see, that's a 2-to-1 risk reward ratio. And the same goes with the bearish flag pattern. It's the same concept. The market's trending downwards, then it starts to consolidate a little bit. Then once it breaks through this trend line to the downside, that's when we execute the trade, full position size, and our stop loss just above the previous high. And then we exit the trade right over there at a 2-to-1 risk reward. So that's essentially the trading strategy that we've used in this example. And you can apply this sort of framework to any trading strategy that you are using. As long as you've got clear rules, well, I'll loosely call them rules for all of these, then you're likely to have a strategy that you can apply consistently to the markets. Hope that makes it clearer. Congratulations on making it to the end of the video. If you like this video, please hit the like button below and share it with a friend. If you've got any trading related questions, drop them in the comment section below. And if you'd like to see more content like this from Pine Street Capital, then hit the subscribe button and join our community on Telegram, where we share trade ideas, market analysis, and more educational content. That's the first link in the description. And if you'd like to work more closely with my team and I to help you grow and scale your trading account, then you can click on the second link in the description, where you can join our virtual trading floor. With that said, I'll see you guys in the next one.